the development of mobility over the past 3 years has been pretty unprecedented. And the fact that there is no playbook on how to manage this, there is no precedent, just makes for a really exciting and dynamic environment to be working in mobility. And again, that's something that I would expect to see continue over the next few years. I think as well for all of us on the call, mobility is a far more strategic part of our businesses now, given the fact that mobility has expanded into some of the areas that we'll talk about with remote and hybrid work. It just is more core across organizations. So again, for me as a tax advisor, again, there's a lot to be thinking about, and we'll cover a lot of that today. Josh?
Thanks, Richard. I think, the part of mobility that I really, truly enjoy is just the fact that it's different every time you touch it. No two situations are alike. You're kind of putting together the puzzle pieces every time you get a new assignment or a new policy, and you're trying to figure out the best way to structure and get the person there so they can achieve what the business is wanting to do, but also doing it from a tax efficiency standpoint and just an efficient standpoint in general. So unwinding that puzzle and being part of that process is really what I enjoy.
Awesome. Thank you. So hopefully you can all see our screens. Just as a quick intro, Richard Tong, I'm a principal at Grant Thornton based out of New York. I lead the Global Mobility Services practice for Grant Thornton here in the US. Josh?
I'm Josh Jagist. I'm a senior manager out of Chicago, and I've been practicing in mobility for over 14 years now.
Thank you. And we are going to be joined by Albert Arazi. He's a senior manager in our US employment tax team. He's going to get into some of the domestic US cross-border considerations that a number of you asked about this time, and we also got questions last time. So in terms of the agenda itself, again, I would thank you for all the questions that you shared. We had around 35, and I would hope that we get some more as we go. And they really fell into three broad areas: the future of work and hybrid work, the return of business travel and compliance obligations, both in the US and internationally, some of the domestic cross-border considerations, multi-state working, and in particular, one of those perennial issues around the convenience of employer that applies in some states. And then lastly, we had some questions around cross-border incentive compensation. So we'll be discussing compliance considerations, practicalities, and management as well. Obviously, to the extent that we get questions in, happy to pick those up, and hopefully we'll have some time at the end. If you do have questions as we go through, then by all means feel free to post those, and we'll do our very best to answer them as we go. So we're going to kick things off, as I mentioned, with the future of remote and hybrid working. And some of you may be kind of thinking, well, haven't you covered that before? And is there anything really left to say? And I think, what's really fascinating about the future of the workplace is just how dynamic this is. For any of you who have read this month's Harvard Business Review, there's a couple of articles in there that are really, really relevant to what we're all addressing, beyond just simply the tax piece of it. One of those talks about hybrid working as the worst of all worlds. Another about how important it is, likening it to one of the most significant workforce transformations since the Industrial Revolution. So how businesses need to think about it. The other piece of it as well is that a lot of the questions are kind of crystal ball questions. What's going to happen in the US, internationally? And so that is something that is really starting to kick off in earnest. It's been a bit of a question mark in the past, and it's been a little anecdotal. So we want to talk about that as well, because I think the one constant here is that, and has been through the pandemic, the policies and the approaches to remote and hybrid working have continued to evolve based upon the market, based upon the needs of the business, and they will continue to do so as businesses model and test the success of remote working approaches. So we'll kick things off. We're going to go a little bit more tax technical than we did last time. But just to revisit some of the issues that we want to talk through, why does it matter from a tax perspective? Well, when people are going on a cross-border basis outside of formal mobility programs, if they're choosing to work remotely or if you've got a hybrid work arrangement, the starting point is, what risk does that bring to us as an organization? And first and foremost is that corporate tax risk. Could the activities of an individual working overseas give rise to a taxable presence for the company in that location? Could it result in an allocation of corporate profits, of registration obligations? And so it's a really core and fundamental aspect of the tax issues that need to be addressed when we're thinking about remote and hybrid working. The second piece of it then is, well, the individuals. And this is an interesting area where there are policies I've seen and discussions I've seen around, well, if somebody becomes taxable in a country, that's on them. And yes, to an extent, but at the same time, an individual may take one tax position that may be contrary, as we'll come to what the employer says. And so individuals may have tax residency that determine taxes. We have to think about exposure as well to both income tax and social security, where the rules typically differ. And then lastly, an area where I expect most of you have got focus is then, what does it mean for you as an employer? Well, corporate issues or not, it may well be that you as an employer have obligations in the country that an employee is working. If you don't have an entity there, and if you do, where is it giving rise to obligations? Is it your local entity, or is it the entity and the country they're traveling from? Again, is that giving rise to tax obligations and employment tax obligations that could impact ultimately the cost of that employee overall for the business? So there's a range of issues, all of which are very intertwined. As you'll be aware, there are double tax treaties, there are bilateral social security agreements, and then within the EU or the EA, there are also rules multilaterally that apply around social security. So there are ways in which these risks can be taken off the table, but they don't apply universally. Not all countries have agreements that cover all countries that your employees may be going to. So again, there's different levels of exposure. You can see on this article, on this slide, these are some of the areas that you may be familiar with. The top one there in Article 5 talks about what creates a permanent establishment. And again, it's the ability to sign contracts, something that used to be more of a bright line test in terms of if people are doing that habitually, then you've got a problem. Where are they working from? Are they working from a home office? That may well be considered a corporate presence in some countries, but for a lot of others, it isn't. So again, it's understanding, firstly, those rules, and again, the fact that they differ by treaty. Again, we've got an Article 14.2. Many of you are going to be familiar with this. It's that famous 183 days of, can somebody work in a foreign country, and if so, for how long? And you see here that up to 183 days in a defined 12-month period. Again, that changes by treaty. Other considerations then around where your employment costs are being borne, and ultimately who is the employer. So we got a little bit there as well on the totalization agreement. And again, that's talking about the context of where you are sending an employee to work overseas. Now, in black and white, these may seem pretty straightforward. But again, it's tax, so nothing is straightforward, and there's an awful lot of grey in there around what this actually means in practice. And what you'll see on the slide are some bullet points that talk to just some of the issues that sit alongside the treaties and the other agreements, that when you take it on face value, you may be able to have people working outside of their home country for a period of time, where you would expect that they can get tax relief, where actually they may not. So the first one there is economic employment. Well, what are they doing in that foreign country? Are they going into the office? Do they have an office? Are they in a role where that entity locally or the business locally is deriving a degree of economic benefit by virtue of their integration into that business? And if so, when we go back to the question here, as to do they have an employer in 14.2b? Well, no, you may not have a legal employer, but you may have an economic employer. And that can be an issue, again, when you're looking at allowing people to work remotely, particularly for those policies that are allowing people to work where you have a corporate presence already. Again, it's an area that can cause issue. Then the domestic interpretation. Again, you would think that it's relatively clear, but not all countries read the treaty in the same way. If you look at between the US and India, and we look at, well, where is income going to be taxed? India may look at an employment in India, somebody paying from the Indian payroll who's going to work in another country, who ultimately is triggering taxation there. You can get differences in terms of who gets the taxing rights. And so it's not always straightforward that countries will line up in terms of applying these in the same way. And that's when you get some tension and friction that may need some degree of pragmatic solution. And depending on the scale of the risk, it may be something that needs to be escalated to the tax authorities for their input. The last one there on the BEPS multilateral instrument, I raised that because, again, some of you may be aware of it. And it's been more focused on the harmonization around digital taxation, where corporate tax profits should sit, and mitigating potential avoidance of taxes through some of the corporate tax planning that in the past has been rather aggressive. Where it plays into a mobility setting is, I'd mentioned before, that from a corporate risk perspective, we're looking at things like where is an employee working and what are they doing? Are they signing contracts? Well, actually, what the Articles 12 and 13 do is to kind of walk back a little bit from just simply signing contracts. And so it expands what could create a permanent establishment by virtue of what an employee is doing. And, again, important, the multilateral instrument, it puts it into the treaties, it puts it into the application of those, but not every country is going to be on board and necessarily apply it. And again, it could be applied differently. So these developments with international tax, while they may sit first and foremost on the corporate side, have the ability to knock on and get into the global mobility setting. So what does it really mean then for all of you? Well, I've been saying for a while now that all of you are being asked to do more with less. The way of operating now requires that everybody is solution focused. And while it may be necessary to say no in certain instances, there has to be a way of finding solutions and pathways to enable the business to operate in the way that it needs to be successful. And that plays into tax and wider mobility. And so those first 4 points are areas where I would expect most of you are looking at this and saying, well, yeah, these are the kind of things that I'm having to navigate in ways that I perhaps didn't have to before. When it comes to tax, the rules haven't changed. And so while we are seeing some small areas where there are developments, broadly tax law is the same as it was pre-pandemic. Those international agreements are broadly where they were pre-pandemic. And some of those agreements date back to, the 60s and 70s. And this is a very, very different world from then. The business continuity perspective is an interesting one as well. And it kind of comes down to other aspects that the business has to solve for when looking at remote and hybrid work. What are the values of the company? How does it translate into the way that you operate? How are you looking at productivity versus employees just simply being busy? And if they are busy, what is it that they're doing? How do you create collaboration and networks internally within the business, and how does that translate into success? And again, for a lot of companies, how are you innovative in a hybrid or remote environment? Now, again, these sit well outside of tax, but they all play a very significant role. So again, going back to that question of, well, haven't we said everything there is to say about remote and hybrid work? Well, no, because these are the types of issues that businesses are going to continually appraise and address. And that then has an impact in terms of what the business does, which again has an impact on ultimately what mobility looks like. So what I'd like to turn to next is that crystal ball question. A number of the questions that we got from you were around, well, what's next? What's happening? What are the trends for 2023? What are certain countries doing? So I wanted just to spend a moment on how we think about the development of policies by companies, law for countries, and in terms of where we stand right now and what it is that we may see. So I think the first important piece of it is, well, who are the core players in this? All of you on this call have a stake in where tax law goes as relates to mobility and how cross-border mobility is managed. Again, the business does from a operational perspective. And so within that, you have representation, industry forums. But then on the other side of that, you've got the tax authorities. What are they being charged with? What is their role in this? Global organizations, as you can see there, the OECD, and we'll come back to them, plays a very significant, influential, not necessarily binding role, but an important role nonetheless in policy development. And then you've got folks like us, advocating on behalf of our clients, but also the ones looking at the rules that are coming out, testing them to see what is valid, and looking at it from the perspective of, are these developments really sensible in the context of what they're trying to achieve? So we then turn to, well, what is the purpose of the guidance? What are the regulations for? Really, what are we trying to solve for? And again, this is when we start to get into some of those complexities. You'll see on that third bullet, well, we're trying to mitigate against things arising that are unintended. That's really been part of the mantra since the beginning of COVID. But again, the OECD signpost back in 2021 that cross-border taxation is going to arise because of new ways of working. So again, how do we mitigate against what's coming up now in a new world? Again, what are we trying to do? Are we trying to facilitate mobility? Is that what countries are looking to do? Well, yes, some of them. Or are they trying to cut the red tape and simplify this and give all of you more certainty in terms of what it is that you need to do? That ties in really to, well, is mobility a catalyst of foreign direct investment? Certain countries where we look at the digital nomad visas, while they can be extremely beneficial in a hybrid and remote work setting, many of them are also focused on developing certain sectors, knowledge sharing, in order to bring people in. It builds up the revenue base, but it also allows potentially for people to enter countries more easily. And again, that can have a focus on certain industries. And so again, these are the kind of questions that we're saying, well, actually, what are we trying to solve for? And again, go back to those stakeholders, and everybody's trying to solve for something. It's not necessarily the same thing. And that then brings us to, well, we have competing objectives. And I think the key one, first and foremost, which is where we all get caught in the crossfire somewhat, is around tax competition between countries. If you have people going from one country to another, do they want to incentivize that? Do they want to encourage people to come, or are they looking to potentially increase taxes? I think, most of us are going to be familiar with some of the tax incentives that have been around for many years. The Netherlands 30% ruling, as an example, overseas workday relief in the UK, that can reduce the tax burden incurred by expats. Well, when you start to look at this, could we find that tax competition is actually around attracting people in by creating those incentives that reduce tax burden? Well, that's great for us as advisors to pick up. It's great for you as well, but it also creates a lot of tension between countries. And could that result in more red tape? Again, how does that tie to immigration? Again, you've got these digital nomads and tax compliance. Obviously, when we start to think about this, we have to tie it to the politics of mobility. Tax is a revenue base. Tax for individuals who are not resident or expats in a country, there temporarily, as well as the immigration. I mean, obviously, all of us know, and we won't get into it here, just how politically contentious immigration policy is. So a lot where there is no easy path forward. And again, it's not necessarily just about enabling. So as much as we would like to see policy and law developed that makes things easier, that makes things clearer, that cuts red tape, that ultimately may not be the objectives of some of the stakeholders. And then just lastly on this, what can we expect? And I think that's where, most of what we've seen so far has been guidance. Guidance from the IRS, guidance from the OECD, none of it particularly recent. And then we get into, well, could we get it within the context of treaty commentary? The UN, the OECD have model tax treaties. May there be something in there that talks about how remote and hybrid work should be addressed, how the existing rules can be applied to those situations? Alternatively, could we get into a multilateral instrument situation? Could we actually get so far as policy agreed within the OECD, expanded out into other nations as well, that actually looks to harmonize the approach rather than it being done on simply a country by country basis? Unclear at this stage. The OECD has announced last year that they are going to be looking at creating a mobility work stream. The intent there is that there will be a scope of that review and a focus by the end of this year. So that is really, we're expecting a Q3, Q4 work in progress. But again, that's only going to start at the beginning. Again, we're going to think about, well, what does that mean longer term? And then lastly, as I mentioned, the domestic country regulations, what are they going to do? Are they going to go enforcement, anti-avoidance rules that may apply to you as an employer? Or is it going to be more incentivizing? So it's very difficult to say. And again, when we start to look at that crystal ball, we have to consider the breadth of what's coming and where it ultimately may go. So again, obviously, I don't have a crystal ball. But, again, these are the types of issues that are informing the way that we as advisors are thinking about this. And I'm sure many of you are internally. And ultimately, this ties into your policy and how you manage hybrid and remote work. So just to bring it back to right now, what does it mean for you right now? Well, we're back with that patchwork. Countries are doing things how countries are doing things. If you look at Social Security as an example, Asian Revenue and Customs in the UK has been a little bit more lenient in allowing for certificates of coverage to be applied in these circumstances. Anecdotally, in the US, the Social Security Administration has noted that, if this is not somebody, as I mentioned before, being sent by their employer to go and work abroad, then it doesn't apply. And the domestic law of the country they're going to should apply. And that obviously can be a very heavy compliance burden. It can also be a very heavy cost burden to you as a business when you think about some of the rates that apply. France is always a good example in terms of how high the employer tax costs may get. So again, it's a lot of uncertainty. I think the key point there in 4 is, well, what? And this I would add is that it's not a plug, it was a question from one of you. What is the role of your tax vendor? Well, it should be as an advocate within the forums that they participate, whether it's a domestic tax law, whether it's part of the OECD, whether it's part of an industry group. It's around advocating for what's important to your business and around sensible tax policy. It's around navigating this for you and informing how you develop policy. So again, it's leaning on and being able to be appraised of what it is that you need to know in order to be as proactive as you need to be to work alongside the business with this. So just lastly, as we on this one, how are policies developing? Well, again, a lot of the questions come back to, how long can I have somebody in another country? Well, we've seen a lot of policies at the 14 to 30 days where individuals are in a country where perhaps it's impractical to really get them set up, where the risk may be relatively low. But ultimately, it comes down to which countries are they going to? What bilateral agreements are there? Do you have an entity there? What is the risk appetite of your business in terms of the exposure that you may be willing to accrue to taxes in another country? Again, those are the types of things that are going to evolve as the policy development does as well. So all of these are factors that really get into how mobility currently is being developed around hybrid and remote working. And in terms of, I'm just going to pick up on a quick question there that obviously plays into it. The digital nomads, they are very attractive. They do allow potentially a facilitation of your remote working policy, or your hybrid working policy. Is great, kind of takes some of the immigration burden off you as an employer. By contrast, some countries, Costa Rica is a good example, they're saying, well, actually, you can come in here for 12 months and there's no tax risk to you, there's no tax risk to your employer. Not all digital nomad agreements are the same. And so others actually trigger the same obligations. It's just simply a way of getting into the country. And so again, it's important that as these develop, as they go through policy formulation, Spain's one that's been a work in progress. Is that something you can leverage and it de-risks, or is it not? So again, it kind of goes back to that patchwork. If you've got something that facilitates, but the tax rules may not, so you've got that degree of conflict. All right, so we're going to turn next then to the return of business travel. I'm going to hand it over to Josh, because again, we had quite a number of questions around this as well.
Thanks, Richard. So I'm going to start with U.S. inbound, and you'll start with your tax compliance as the employer. And as Richard was referenced earlier, I hear a lot from clients or people I'm talking to in the mobility space. Oh, that's less than 183 days, and they're less than 6 months in the U.S., so we're good. We don't have to do anything. Well, that can be true in some instances when you're looking at tax treaties. There's a lot of different things that go into it, and we'll talk about here in a minute. And really what you want to start with is a residency review there, and making sure that you're not blowing some of those first points in the treaty that Richard had gone through earlier. But some critical things to consider as an employer is firstly sourcing the income between the U.S. and the other country that the person is, making sure that those payrolls are aligned and that the allocation of income is aligned, so that you're not overpaying or underfunding income taxes and falling into some reporting threshold issues where you're having to go back and amend payroll filings. But also, if you leave the employee on their own, that they're not overpaying or underpaying their tax obligation, which would then fall back to you. The other part of this is, as I referenced a minute ago on the treaty and the 183-day rule, well, that may give you some leeway on income tax. There still ultimately is a tax filing obligation to disclose the amount of income that's being earned in the U.S. as a person coming in that you're excluding from treaty, which would require the company to issue a 1042, but it also would require you to collect a W-8 from the individual. And it is something that's been on the docket for the IRS. I know they always are saying they're looking into things, but it has come up more frequently, and this is an area that they're exploring into further auditing and reviewing for companies as a non-compliance area. So even though they might be covered from treaty and the tax risk is low, there still is some compliance obligations that the employer is required to meet. And then, of course, you've got payroll and W-2 withholding if you're falling into the non-treaty or they're over the 183 days, making sure that you're withholding and remitting and reporting on W-2s for the part that they are employed and earning in the U.S. And then adjusting home country payroll accordingly, so that you're running into, if there's situations where you can reduce the withholding on the individual through a withholding adjustment or a filing obligation that you have with the home country, just to make sure that the double taxation is reduced. Which then we kind of get into the employee tax compliance. So you might be thinking, okay, we're good. We've done our obligations as an employer. We've filed the 1042s and we've withheld and remitted payroll. And now the employee's kind of on their own. Well, in some cases you can do that, but oftentimes it's more complicated. And it really starts with that. For the first point, it's super critical, is getting a taxpayer identification number. But oftentimes, if you're having business visitors come in, they're not going to be, depending on the visa type, they might not be eligible for a social security number, which means they have to go through the much more difficult route of getting an individual taxpayer identification number, applying for that through the W-7 application process with their individual tax returns. And then the really tricky part about this is, a couple of years back, the IRS changed the requirements for documentation support on the W-7 filing, where you now have to have a certified copy of the documents from the issuing agency, or it has to be certified by a certified acceptance agent of the IRS, or the actual originals need to be submitted. So it's become a much more onerous process for the employee to get a taxpayer identification number that actually allows them to file their individual tax returns. The other quick two things I wanted to highlight here, the state liability, that becomes super critical. Not all states follow treaty. So if you may be thinking, okay, I'm good, we've got a person here under the treaty limits, US, we're all set. But then you look at the state liability and they may not follow. So California is the prime example. They don't follow income tax treaty. They would still require that person to be taxable. And we all know the California rates are high. So if you have a higher income earner coming into the US, you could be generating some significant state liability that wouldn't be covered under treaty. And then the last point here on country reconciliation. So if you do leave your employee on their own from a tax compliance standpoint, there could be some duplicative taxation that's going on, or they may be getting some kind of benefit from going into the U.S. due to difference in tax rates or whatever it could be. It could be critical to do this reconciliation calculation and make sure that they're not unfairly burdened or unfairly advantaged by working in the U.S. for a temporary period and tying it back to what the taxes they're paying in the U.S. versus their home country. And then lastly here on policy issues, we kind of touched on some of these with the compliance parts, but you're going to run into situations where duplicative withholding is required, where you're withholding in both countries. So having a clear and concise policy on how you're going to handle those particular situations is really critical to this. So you can, refer back to it, or make sure that the payroll is adjusting accordingly, or the employee knows that they may be out of cash for the time being, but you'll either make it up through payroll adjustment or reconciliation later down the line. We talked about equalizing employees a little bit. And then lastly, just how you're supporting your employees as you're asking them to travel into the U.S. with all these different obligations from a W-8 and an ITIN and a tax filing and reconciliations. What level of support are you going to provide as an employer to facilitate some of these business travel issues? I hand it back to Richard to talk about outbounds.
Thanks, Josh. So just quickly, again, we've talked about that's the US and what you need to do. I think it is important to recognize that as you've got people leaving the United States, what are those obligations? Maybe the treaty just automatically applies. There's no additional obligations. Obviously, in some countries, as many of you will be aware, there are the short-term business visitor agreement, the scheme you can put in place in the UK is an interesting one. Won't apply in the US because in the US an employer is not allowed to effectively assert residency status of an employee or of an individual on their behalf, whereas in the UK it's effectively what they're doing and confirming, yes, these folks meet the treaty exemption. So again, as people leave, it's important to be mindful of what it can mean there. Other considerations too around your corporate structure. If somebody, for example, is going to from a branch of the main entity, then again potentially they're effectively employed by the company that they're going to, and it can mean that if you're traveling from a branch, then potentially you are going to trigger taxation. Just a few issues, mindful of time, in terms of the obligations and how to manage them. You can see there just some of the issues. This kind of comes down to the demographics of your employees and the location profile. Can you see within that, what are the variables that may make a location higher risk? Is it the volume of employees? Is it the nature of the work that's being done? Does it come down to the actual country and how they treat business travel and how they look at tax relief? So again, I think it's important to make sure that there is a segmentation to actually identify where you need to prioritize your time. And again, what degree of risk might you be accruing? Josh?
Sure. Thanks, Richard. I do think, the last point here on leveraging technology is really critical in helping you identify, this could be a very manual process when you're looking at volume of travelers and who's traveling and collecting their information, but using the technologies that are available to automate some of the reviews and risk profiling can really help you get a handle on what your risk profile is as a company at the moment, and then B, how do you put a mitigation strategy in place where you're attacking some of these higher risk areas, higher risk employee groups that Richard just talked about, and then making a really practical attempt to comply as the tax compliance obligations and each country can be quite onerous and practical to actually comply with the day one regulation if you had to. So demonstrating some ability to mitigate some of this risk and identify them through technology and automation.
Okay, thank you. All right, so we're going to move next to focus on the US and just the domestic cross-border situations. What happens and what does it mean when someone's going from one state to another and crossing domestic US state borders? So Albert, I'm going to hand over to you. Perfect timing. If you'd like to kick things off.
Sure. Thank you, Richard. So pleasure to meet everyone. So as Richard mentioned, today we're going to talk a little bit about U.S. payroll taxes, especially when you have individuals coming into the states or even crossing states for work purposes, and some of the complications around that. In the U.S. specifically, as many of you may know, we have 50 states, and as a result, we have 50 different set of rules potentially when it comes to things like state income tax, local income taxes, and state unemployment taxes. So getting your hands around this can be somewhat of a challenge. I was asked to talk a little bit about this because we did get some questions for inpats or globally mobile individuals who are traveling across state borders, and there was some interest in that. If we look at the states as a whole, the taxes from a payroll standpoint generally fall into three categories. There is the state income tax withholding piece, there is the state unemployment tax piece, and then there's also, in some jurisdictions, local income taxes. For example, in the state of Pennsylvania, there's 2,700 different local taxes that you have to consider depending on where the individual is working. As a whole, if we could turn to the next slide, one of the challenges that organizations face is specifically around state income tax. And the reason why this is the most challenging of the payroll taxes is because there's inconsistency across the board from state to state. As a general rule, if we were to take a look at the United States, all 50 states, the vast majority of them will tax individuals or have the employer withhold from individuals based on where the individual's physically performing services. That's sort of the default, and it's probably the easiest one to administer and understand. However, we do need to understand exceptions to the rule. And so there are some states, obviously, that don't have an income tax. There are some states that have reciprocal agreements with each other. A reciprocal agreement is basically when two states have an agreement with each other, and they basically say, we are not going to tax each other's residents. An example of that in the Northeast, where I am, is between New Jersey and Pennsylvania. So New Jersey and Pennsylvania have this agreement that says if you have the residents of New Jersey go and work in Pennsylvania or vice versa, we're only going to tax the individuals in the resident state. This is common in the what I'll call the Mid-Atlantic area, Pennsylvania, New Jersey, and the DC, Maryland, Virginia area. And it's also popular in the Midwest. In the rest of the country, it's less and less popular, but it is something that you need to consider when you have employees traveling. There are also some jurisdictions that say if you have a non-resident who is coming to perform services in our jurisdiction, that we're not required to withhold until we reach a certain threshold. So some states have a 0-day threshold, some states have a 10-day threshold, some states have a 14-day threshold. The highest one that I'm aware of is about 60 days. And so understanding this could be important in understanding your tax exposure and tax landscape. And it also help you make business decisions around registering in a jurisdiction and what you're obligated to do. The fourth exception is around convenience of employee rules, and this is actually a question that we got a few times in the lead up to this meeting. And for those of you who are not aware, a convenience of employer rule is a rule that basically throws the whole concept of physical presence out the door, and it says essentially, and I'm paraphrasing here, if you have an individual who would have worked in our state, but they are working from home remotely for their own convenience, it's as if they physically worked in our state for that day. By far the biggest or most well-known convenience of employer rule is the New York convenience of employer rule. And this is incredibly important for any businesses that have a New York presence or a significant New York presence. And New York basically states that if you have an individual whose primary office is in the state of New York and they are working from home remotely, whether it be in a different state or potentially a different country in some situations, but they do perform some services in New York or perform services within and without the state, then that individual is very likely subject to New York state taxation, or it's as if the employee is physically present in New York for those days, unless we can reach conclusion under the convenience of employer test that the individual's home office is a bona fide place of business for the employer. Now, there's a test out there that some of you may have seen. It's almost impossible to meet that test. I can tell you from my experience, 95% approximately of the time, employers would fail that test, or a specific employee would fail that test and would be subject to New York state taxation. So this is something that has been around well before the pandemic, but has become increasingly important because of employers shifting to a remote work environment and allowing their employees to work remotely from various jurisdictions. So this is certainly a consideration to think about. With that, I'm going to pass it back to Richard and Josh.
Wonderful. Thank you, Albert. So just for the last section we'll cover quickly is just around cross-border incentive compensation. We're going to talk about this in the context of international, but it's very much a domestic issue too that Albert can jump in. And so I'm going to pass it over to Josh just to kind of talk through some of these key considerations.
Sure. Thanks, Richard. So we wanted to chat here on a couple of things just to have in your mind as you're thinking about your incentive compensation. And by no means is this meant to be a comprehensive list of all the issues that can come up with an incentive compensation in international setting. But it really starts, and some of the questions had asked about how you're allocating taxes and withholding and how you're taxing in the different jurisdictions. And it really starts with how you're apportioning the income tax. And we work with a lot of clients, and oftentimes when we come in as a new provider, the answer is always, oh, we've got the equity solution for our equity administrator, and they're kind of apportioning the taxes based on payroll or assignment or some kind of practical answer. And that's all well and good, and in some cases it works really well. But you run into a lot of different tax jurisdictions that will have different taxing points where they'll tax on vest, or they'll tax on exercise, or they'll tax a different on sell, or whatever it could be, where you're misaligning the apportionment. And some of the issues that you could run into there we've seen in the past is if you end up apportioning a lot of income into one country where it shouldn't be, and it goes through payroll because it's automated, you could potentially generate significant tax refunds for the individual in that particular country. And oftentimes you're finding that those refunds are due back to the company because you've paid the taxes on the expat assignment. So you run into a collection issue, one. Two, you run into some tax issues with how do you treat those refunds in a payroll perspective and an income tax perspective from both countries' jurisdictions. And then you just run into the messiness of trying to work with the different authorities to get the money back. So apportionment may seem simple. There's a lot of different things that go into it. Just really be conscious of how you're apportioning your equity between the two jurisdictions.
Josh, if you want, I could just jump in here quickly on the apportionment. So just to give everyone a little bit of background on that, there are many employers that may offer equity plans that are cross-border or potentially long-term incentive plans, cash incentive plans, and many times understanding what is subject to U.S. taxation versus what is subject in a foreign jurisdiction is important. Our experience at a high level is generally that from a U.S. standpoint, the taxation is allocated depending on two things. One, residency status of the individual, and two, how much they perform services in each of the jurisdictions. So, for example, if we're talking about stock options, generally the determination of how to allocate the wages is done between the grant date of that option and the vesting date of that option, even though the individual may not exercise that, for a few years later. So that's something to definitely consider from an apportionment standpoint.
Great. Thanks, Albert. Really appreciate that. A couple other things to hit on here on the trailing compensation. So there are some questions in the emails about permanent moves and how do you deal with apportioning income and taxing it in the jurisdictions that from the person departing and arriving. You've also got the considerations here where you've had a long-term expat that's granted awards that you were earned over several years, invested a year of departure or years down the line, and how you deal with those particular issues. And as oftentimes it comes with mobility, it depends on the country and the jurisdiction. We've got to really look into the agreements between the countries from a treaty perspective or a totalization perspective to understand the requirements from social tax and income tax and withholding. But some of the other things that are not so obvious with when it comes to reporting and paying the trailing compensation and on payroll is, do you have a payroll open for this person anymore? Are you even operating in the country of jurisdiction that the person was in, and how are you going to report and remit to those particular countries? Things like having the person keep their tax ID number open as long as they have trailing income associated with that particular country, so they can actually file returns and you can report in compensation into payroll. And littler things like keeping a bank account open, it can be really challenging or necessary if you're expecting refunds to come through from apportionment and those type of issues. So it seems simple just to track it, but it could be some things that could run into problems down the line. So if we go to the next, just kind of talking about how we could be successful in working through incentive compensation. And really, it comes down to a couple things: collaboration and communication. So working within your different countries and payroll experts within the different jurisdictions and the equity teams understand, like Albert was saying, how the income is supposed to be apportioned, how it's supposed to be reported, how you're withholding, what your system is set up to do. Having a really honest discussion with your equity provider on what they're able to accommodate in the system, so you get the appropriate taxing rates from a hypothetical perspective or an actual perspective. So really nailing that down from a collaboration process, and then having a really robust procedure and documented procedures on how you're going to handle these different situations as they arise, especially when you've got somebody going in to a new country or leaving a country and what you're going to do. And then lastly, the thing I wanted to highlight was communication with employees. That's super critical. Oftentimes the systems don't allow for accurate withholding because of statutory regulations or limitations on what you can do with hypothetical withholding in an equity provider solution. So just being open with the employees so they understand that what they may have sold to cover is not going to cover their entire tax liability, or what you may have had to do from a statutory perspective is to sell to cover more because it's a requirement of the country, but that they're going to be out of pocket for a little bit until they get a refund, and helping them to manage that expectation so that they're not thinking they're unfairly disadvantaged by taking this assignment. I know that was a super quick walkthrough on some of the successes. If there's any other questions, we're happy to set up time separately to go through them. But I'll hand it back to Richard.
Thank you, Josh. So just one quick point that I think is a nice question that we had posted in the chat that covers a lot of what we've talked about today is, when does someone have to file a federal tax return? When do they have to file a state tax return? If you've got somebody coming into the US, it could be, a very, very low amount. There's no standard deduction potential that they can take. It may be that there's no treaty they can avail of to exclude their income. So from a federal tax return, it may be, any income could be taxable. There is a federal threshold of $3,000 with some other conditions that could apply, but obviously that's very, very low for a lot of people coming in on a business trip. Obviously, as Josh highlighted earlier, if you're on a business trip, strictly, you have to file, even though you have no taxable income, simply in order to avail of the treaty benefit. For a state, maybe different. Again, as Josh referenced, California as a good example, maybe that there is no federal taxable income, but it may be that there is state taxable income. So states need to be looked at in terms of those that do not follow the tax treaty and what are the thresholds on an individual state basis, and then how do you file? Obviously, that can lead to payroll complexities. Can you issue a W-2 for somebody who has no federal taxable wages, no social security taxable wages, but they do have state? So again, practical considerations, there are challenges there. And obviously the letter of the law can be quite strict in terms of the compliance. And And again, that informs how you, as a mobility leader, as a business, are going to manage this. So I'm going to wrap that there. I'm going to hand back to Andy to close things out. But in the meantime, we appreciate you all attending and sitting through this. And as Josh said, if you do have other questions, by all means, feel free to get in touch with the three of us.